What do you mean by digital?
I do believe we're just at the beginning of the tokenization of all assets, from real estate to equities, to bonds, across the board.
It's very loud here.
It is very loud.
But it's good. Capital's at work, Larry. You like that.
I love capital at work.
That's the frame Larry Fink wants on the future. Everything that can be digitized will be, and capital will follow. The core of his thesis isn't speculative hype, it's distribution. Tokenization turns static products into software-like rails, pulling savers from the sidelines into markets they've never touched. If crypto is the on-ramp, tokenized funds and cash are the highway. And BlackRock, in his telling, is already driving.
Yeah. But there's $4.1 trillion of money sitting globally in digital wallets. A lot of that money is outside the United States. If we could tokenize an ETF, digitize that ETF, we could have investors who are just beginning to, invest in markets through, let's say, crypto. They're investing in it, but now we could get them into the more traditional long-term retirement products.
Fink's bridge from wallets to wealth is simple. Use crypto familiarity to funnel capital into regulated, long-horizon vehicles. That flips the old narrative on its head. Instead of crypto siphoning money from traditional finance, tokenized wrappers could pull new cohorts into it. In that world, volatility is a feature, not a bug. An attention engine that on-ramps users to disciplined ownership. The explosion, in his view, is adoption-led.
So we look at that as the next wave of opportunity for BlackRock over the next tens of years, as we start moving away from traditional financial assets by repotting them in a digital manner, and then having people stay in that digital ecosystem. They can have their cash.
This isn't a quick pivot. It's a decades-long migration. Repotting legacy assets into a digital soil keeps investors inside one seamless experience. Cash, funds, and markets living side by side. Once the container changes, behavior follows. The user doesn't need to go to Wall Street. Wall Street comes to their phone. That's how step changes in participation happen.
And we have the largest cash money market fund that's tokenized called BITL. Our Bitcoin IBIT is now over $100 billion.
$100 billion, I know, from nothing not that long ago.
And 2 years ago, zero.
Numbers cut through noise. A tokenized cash fund plus a six-figure million BTC vehicle in 2 years suggests product-market fit, not a passing fad. This is the institutional language of it works. Scale, assets, retention. The crypto rail becomes a distribution channel. The tokenized cash becomes the parking lot. The ETF becomes the long-term home. Momentum begets more momentum.
So it was not just one product area, it was not just one region, it was a completeness. And I think it comes down to the whole portfolio, the entirety of a conversation.
Fink's broader point. The digital push only lands because the rest of the machine hums. Crypto doesn't sit in a silo. It plugs into ETFs, private markets, and tech. That portfolio-wide conversation is why tokenization isn't a science project. It's an operating strategy. When every shelf in the store moves, customers don't notice the rails, only that it's easier to buy.
When we bought BGI in 2009, no one thought you could marry passive and active. Well, not only we did that, we've transformed how a portfolio is being engaged. And now with passive, active, publics, privates, and then we overlay investment technology, and now digital, we're the firm that more and more people are going to worldwide.
Past integration sets the precedent for the next one. If passive and active could be stitched into one interface, digital and tokenized can be stitched to the rest. That's the pattern Fink is signaling. Absorb, unify, distribute at scale. For investors, it means fewer gates and more access. For markets, it means liquidity turning up where it didn't exist before.
So a great statistic, if you put money to work on January 1st, 2000, and a year later you had the dot-com crisis, 6-7 years later you had the financial crisis, you had the COVID crisis, you still would have made 8% compounded over that entire 25 years versus earning 1%. It is so compelling to be in the market.
Underneath the tokenization drumbeat sits an old truth: compounding rewards patience. The point of smoother rails is not to encourage more trading, it's to keep people invested. If crypto is about to explode higher, his argument is that the real payoff is staying on the ride after the hype fades. Rails reduce frictions, habits do the heavy lifting.
It's not about if our market's going up or down. Is there a bubble in crypto or is there a bubble in technology? It's about being in the market throughout the cycle.
Cycles frighten traders, they fortify owners. Fink keeps steering away from short-term calls and back towards structure. Tokenization in this frame is less a price forecast than an inclusion forecast. More people, more often, owning more of the economy for longer. That's how explosions in market cap become durable.
Even if you put money in the United States in the year 1900, and then you had the Great Recession, you had the Depression, you had all these things, you would have earned over 9% over 125 years. So I'm not here to tell anybody if the markets are going to go up or down, but over a long horizon. And
history is his closing argument. The long arc bends toward returns for those who persist. Digital wrappers won't change human nature, but they can make the right behavior easier. In that sense, crypto exploding higher is as much about user growth and time in market as it is about price charts. Adoption is the multiplier on compounding.
And another interesting point, I think I've said this before, but over a 30-year cycle, if you earned an extra 0.5%, over 30 years, 0.5%, your retirement pool of money is up 15% more. Just 0.5%. So the virtue of compounding over 30 years, there's nothing more important.
Basis points matter because they scale across decades and millions of users. Tokenized cash that settles faster, tokenized funds that reduce friction, crypto rails that reduce borders. Each shaves costs or adds access. Add those basis points to the compounding engine, and the macro effect looks like an explosion from the outside. From the inside, its design, we've heard Fink sketch a future where tokenization is the default container for assets, where crypto rails recruit the next generation of savers, and where long-term ownership, not short-term trading, does the real compounding. We walked from digital wallets into tokenized ETFs, from tokenized cash to six-figure million BTC products, and from crisis-ridden decades to the math that still wins. If crypto does explode higher, his blueprint says the real story is broader participation and better habits riding on better rails.
And the young people who are worried, they're not going to have much to worry about. America still is the best place in the world to invest, and I would be continuing to invest here today.
What do you think? Does tokenization become the everyday doorway into markets? And if so, which asset do you believe will be the first mainstream breakout on those rails?